I want to thank everyone for joining us for today's program. This is the Making Your Dream a Reality webinar. This was the third webinar in the Purdue Succession Planning Team webinar series that we hosted the winter of 2020. Unfortunately, we had to delay the final webinar of the series. I'm Jenna Neese. I'm a member of the Purdue Succession Planning Team, and I'm really excited to be offering today's program. This webinar, like I said, was part of our succession planning team programs that were offered the winter of 2020. They are funded through the USDA NEFA under a grant. So we want to make sure we thank our sponsors for helping us with funding for this program. As I mentioned, I'm part of the Purdue Succession Planning Team, and there are a number of team members across the state that has been a part of getting this program ready, and then also that are working towards making programs for later in 2021. You can tell by the image on the screen, we're located around the state, and we've actually added a few more team members, so we've got a few other individuals that could help you if you have questions on succession planning. And with that, I'm going to actually stop sharing my screen and allow our presenter to share hers. So. All right, so our presenter today is Dakota Everett. She works with Farm Credit and is going to talk to you guys about the lender's side of getting, or lender's perspective of getting a loan to help you with your farming dreams. So with that, I'll turn it over to Dakota so she can tell you more about herself and give you guys some more information about the lender's perspective. Thanks, Dakota.
Thanks, Jenna. Can you hear me all right?
Yes, we can hear you.
Perfect. So I just wanted to thank you for allowing me to have the opportunity to virtually share this presentation with you. I know that wasn't the original plan, but grateful for technology and being able to get this information to you guys. So thank you for this opportunity. Like Jenna said, I'm going to be sharing the perspective from a lender, so the idea of growing your farm team and getting all the right partners in line and on your side as part of that succession planning process. So that's the perspective that I'm going to be sharing with you all today. Happy to take questions, or if Jenna has those, address those as they come up or however she sees best fit, but happy to answer questions or find you answers if I don't have those today. So let's get started. A little bit of an introduction and an agenda. So I'll kind of introduce the company I work for and what I specifically do at Farm Credit. And then we'll kind of jump into the content of today's session. So talk about goal setting, why that's really important to share with your lender and how we kind of think through goals and getting you to where you want to be. Talk about financial information. So obviously from a lender's perspective, and when you think about succession planning and getting to your end goals, the financial piece is really important. And so I'm just going to walk through some things the lender might ask you for, why they're asking you for that information, and then what we're actually gleaning from that information. And then I'll go into lender expectations. So sitting down at the table across from a lender can be scary sometimes. We all do it for different reasons throughout our life, purchasing a house, buying a farm. And so it can be kind of an anxious process if you don't know what to expect. And so trying to take some of that anxiety out of what a lender expects from you and what you should expect vice versa from your lender. And then I'll wrap up. And like I said, happy to take questions as those come up. So a little bit about Farm Credit Mid-America for those that aren't familiar. We are a $25 billion ag lending cooperative, and we serve Indiana, Ohio, Kentucky, and Tennessee. So you can see on the map on the screen our 4-state territory footprint, if you will. I'm right there in Greencastle, Indiana, and then our headquarters are there in Louisville, Kentucky, the star on the map. But we provide loans and leases to farmers, agribusinesses, and rural residents. We also have a kind of a business segment called Rural First, and they provide loans to people that live out in rural America. So if you're looking to purchase a property for hunting or recreational activity, or wanting to buy a house in the country, build a house in the country, Farm Credit can do that via our Rural First program. And so that's just to give you high-level information of who Farm Credit is. Won't spend a lot of time on that. Talk very briefly about myself. As Jenna said, my name is Dakota Everts. I'm the Growing Forward Specialist for the state of Indiana. I'm based here in Putnam County, and prior to COVID, I traveled Indiana quite frequently. Now I travel the footprint of my house quite frequently, as most of you are probably doing the same. But I did graduate from Purdue with an ag finance degree in 2014. And then, like I said, I managed the Growing Forward program for the state of Indiana. Married with one son, and my husband and family and I have a small flock of commercial ewes that we like to think is a business, but it's pretty small. So a little bit about Growing Forward before I really get into the meat of the presentation and why you guys are all here, just to give some context. So Growing Forward is our program that meets the unique financing needs of young and beginning customers, understanding that young people trying to get involved in agriculture face unique barriers that people that have been farming for 10, 20 years don't face. And so we designed a specific program for that at Farm Credit. It's essentially relaxed underwriting standards. So a little bit later in the presentation when I go over financials, I'll kind of hit on what are those underwriting standards that we at Farm Credit use. So this program specifically knocks those standards down so that young and beginning farmers have a better chance of actually getting approved for a loan. It provides support from loan application to graduation from the program. We do offer educational opportunities. Most of those are in person. We've had to adjust and offer some of those virtually to our Growing Forward customers. And there is an interest rate break for those young and beginning customers that are in the program. So I manage that for the state of Indiana, and the program actually encompasses all 4 of our states. I just cover Indiana. So why are we here? We want to understand what a lender needs to help make your dream a reality. Like I said, my goal is to give you information that takes some of the anxiety out of meeting with a lender. If you have that anxiety, or if you like to be super prepared, what do I need to have with me? What do I need to be ready to discuss when I talk to my lender? And really, what am I looking for in a lender that makes them an ideal partner in the succession planning circle, and just for my operation in general. So that's why we're here, and I want to answer those questions. And if I don't, please make sure you ask them so you can get the information that's most useful to you in your operation or your situation. So the first thing I'm going to talk about is goal setting. It may seem a little elementary, but I think goal setting is one of the most critical pieces that we can talk about when we're talking about sitting down with our lender. If we don't talk about what our short-term and long-term goals are to our lender, I don't feel that they can make the best decision for you and your operation. If I don't know where you're wanting to go, I don't know how to form those conversations to get you where you want to be. So goal setting, we want to talk about short-term and long-term goals. And we want to talk about personal, family, and business. That's not to say that your farm lender needs to know every personal goal you have, but we want to make sure that the decisions we're making for your operation are not going to get in the way if you have personal goals. We want to make sure those are all going the same direction. So the idea that all those goals need to mesh is really important. It helps provide direction and priorities for both of our action. So it's going to help if you have those goals set and you're communicating that to me as your lender, it's going to provide direction for you to start making steps on your operation or in your home to get to those goals, and it's going to provide direction for me as your lender to suggest different products or waiting versus purchasing now. It's going to set direction for both of us. And it's really going to provide a starting point to mark accomplishment. So if I know where we're starting and I know what our goals were now, in 10 years from now, I know what our starting point was. So I know, did we accomplish what we wanted to set out to do? Because from Farm Credit's perspective, and really any lender's perspective, is that we're a partner in this. We're investing in you and your operation from a lender's perspective monetarily. And so we want to know, were we successful? As in any business, we want to be able to measure success. And then, so I have some examples on here of personal, family, and business goals, both short-term and long-term. If you're kind of struggling with where to start on writing those goals down, and I would encourage you to write them down, not just have them up in your head. But personal goals, so attend 2 conferences in 2020 and read 4 books in 2020. Maybe those are some personal goals, but we want to make sure they're specific, they're timely, that we can realistically achieve them, we can measure that we successfully achieved the goal. Family goals, go on a vacation this year, build a new home in 10 years. And business goals, maybe I want to buy a new sprayer, but maybe I also want to purchase 80 acres in 5 years. So that's a great example from a lender's perspective. If you come in now and want a piece of equipment this year, but I know your goal in 5 years is to purchase that 80 acres down the road, how important is that sprayer? Is it vital to the operation and continuing on? Then yeah, let's get that done. But if it's not necessary, if we can make things work, maybe it makes sense to hold off on that purchase so that we can make some other purchases happen given your individual financial standpoints at different points in time. So those are just examples to kind of get you thinking of how goals can work together or against each other. And then the idea of sharing your goals. So I've talked a lot about sharing your goals with your lender, but also sharing your goals with your family and your business partners, and all those kind of in your circle when you're talking about building your farm team. If everybody knows the goal, then everybody's working towards the same endpoint. If I know the goal, your accountant doesn't know the goal, and mom and dad back on the farm maybe know some of the goals, then we're not really on the same page. So sharing those goals, talking about those goals, updating those goals, and for a lot of times for family and business partners, that's a budget. That's just sharing what our plan is on our operation for our budget, or in our homes if we have a personal budget. And for your business investors, that's a business plan. And so that's kind of what I'm going to get into next, is the idea of what is a business plan and why does my lender care if I even have a business plan. So it's a really formal way to outline those goals and objectives. You know, you can sit across the desk from me and tell me what your operation goals are, and I can listen to those and I'll write those down if I'm good and I'm good at my job. But oftentimes, if we have a formal written out business plan, that's super helpful for your lender to understand what you're wanting to do and how you're going to accomplish it. I also think it challenges customers to think through what-if scenarios. So all of our young and beginning farmers in the Growing Forward program have to fill out a business plan in order to be part of the program. And I think one of the best parts of them having to do that is it asks questions and makes them think, have I even thought through that aspect of my business? And oftentimes the answer is yes. You know, you have it up here, but have you actually gone through the process of, you know, my what-if scenario is if I can't farm, this is the plan. Well, does that person know that that's the plan? Have I had that conversation yet? And so it really kind of takes the planning process to the next step. It helps me as your lender understand your operation, holds you accountable. I know if I write something down, I'm more accountable than if I just leave it up here in my head. And it gives us insight into your management capacity. If I get a well-written business plan put down on my desk, I feel pretty good about that customer's management ability. And that's a really critical piece of a loan decision. You know, the financials play a huge part in a loan decision, but the management capacity plays a really important role in a decision as well. So what are the elements of a good business plan? What is your lender looking for if you're going to actually give them a business plan? So realistic and measurable goals. I talked about that earlier in the goals section, but if you're just putting down really lofty goals, you might seem ambitious or you might seem a little bit crazy. And so we just want to make sure that the goals are attainable for your operation. So are they realistic, and can we measure those goals? The next thing is the time and effort put into the plan. I've read countless business plans being in the Growing Forward program, and it's always pretty apparent to me who's sat down and put the time and effort into the plan and who maybe put the plan together the night before the business meeting. And so it's kind of like studying for a test if you can put yourself in a time and place when you were doing that. The more time and effort you put into the plan, the better the business plan itself is going to be, the better the operation is going to be. The less time, probably the lower the outcome on the test or exam. So comparing it that way is helpful to think through. And then the other thing I'm going to look for, or that any lender is going to look for, does it evolve with your operation? So probably at the beginning of 2020, people's business plans were going to look pretty different, right? We weren't expecting some of the things that we've come to face this year. So I think the idea that knowing a business plan is a really good idea, and I'm going to spend time and effort on it, but I'm also going to evolve it with my operation. So there's no way I can plan for something like COVID-19 and the economic impact that it's had, but I can adjust accordingly. So I can pivot and figure out what that means for my operation, and I can update my business plan accordingly. And I'll just kind of end on, the more your lender knows about your operation, the better partner they can be. Obviously, you only want to share what you're comfortable with sharing. No one's going to ask you to share goals that you don't want to share or that are personal, but the better your lender can understand you and your operation, the better they are going to help you in your operation. So this is an example of what our business plan looks like at Farm Credit. I'm sure if any of you wanted a copy of this, you could reach out to Jenna and I could make that available. But just as an example, no business plan is going to look the same, but sometimes it's helpful to have a template. But what should my business plan include? The first is a capital request. What are you wanting, and what are you going to use the money for? I like to use a really basic analogy of, when I was in high school, if I'd asked my parents for $20, I usually had to explain why I wanted the $20. It's really no different whenever you're coming and asking for large sums of money for your operation. What are you going to do with this money? And so the better you can communicate what the goal is with that money, the better that plan will be. A business overview. So you know better than anyone what you do on your operation. So sharing that with your lender, sharing that with your business partners in that circle is really critical to explain. The third is a production system. So not only what does my business look like, but how do I produce what I produce? How do I get it from start to finish? What's my competitive advantage? So a lot of times, some of the best businesses have really great competitive advantages, right? We're getting, maybe we're really good at cutting down our fixed costs one way or another. Maybe we're getting an increased margin for some kind of product that we're growing or raising, but how are we doing that? As a lender, oftentimes we're defaulting to places like Purdue that are telling us, this is what an average income and expense looks like, or this is, average if we're going down. You can kind of see there on the right-hand side, there's depreciation, feed, fertilizer, freight. We're going to use averages there unless you tell us otherwise. So if you're getting some kind of competitive advantage, that's awesome. Most successful operations do, but communicating why and how you're getting that competitive advantage is really important. A crop and livestock plan, letting us know what you grow, how much of it you grow, and then any kind of insurance and contingency plans you have in place is pretty critical. And then just finally, financial projections. And like I said, that's difficult to do, especially in agriculture and especially in years like this in agriculture, but doing your best to outlay the next year to say this is what I think my operation is going to be able to produce is what we're looking for when we're talking about a business plan. This kind of shows you the scale. So a detailed business plan with well thought out goals goes a long way for a lender. So if they're highly detailed, that's great. If they're complete, they're in the middle, you're better than most. And then there at the end in red, if you've got nothing at all, then it's really hard for us to gauge where you're at and where you're going. And so I'll kind of end the business planning section, if you will, of character and management is something that you can control. And I ask people all the time, if you're coming in to a lender, what if it were your personal money that you were lending out? What all would you need to know to feel comfortable saying yes? And so oftentimes we want to think of lenders the same way. If they're our partners, they're asking these questions and they're asking this information because it's not their personal money, but they are responsible to a company when we're making those loan decisions. So just thinking about it that way might be a new way to approach that information or sharing with your lender. Jenna, I don't know if you want me to pause if there have been questions or just jump right into this next section.
Actually, we do have a question.
Okay.
So what helps other than a business plan to be approved? I was not approved to purchase land because of my tax return showing little or no profit over 3 years. Those were the first 3 years, but I can't get a profit without gaining more land to better manage my operation.
Sure, that's a good question. So a lot of different reasons that could be. But the first thing I'd say is kind of back to the idea of competitive advantage or sharing things that your lender might not know. So being an ag lending cooperative, we understand that a lot of times tax returns don't show that you're making money, right? But we have to prove otherwise that and you may be making money. You know, you may say, I'm making money, but my tax returns don't show it. We have to have some kind of documentation that says you are making money. Because I'll get to it in the financial information piece, but we want you to be able to pay your loan back with profits from your operation. We don't want you to have to sell assets from your operation to pay a loan back. So that's the biggest piece, is if you have information outside of your tax return that says I'm making money, that could be a really critical piece. The other thing you could have prepared for a lender, if you know, and I'm trying to think, some operations that we work with, they know they're not going to be profitable till year 3 or year 5, especially given different industries. That's kind of known. If you can lay out a 5 or 10 or whatever it's going to be year projections to say, you know, year 1, 2, and 3 are investment years, year 4 and 5 are when we're going to flip. That's when we're going to see those margins increase. If you can lay out financial projections that show that, that could help in the loan process. So anything that you can either show that if it says on your tax returns you're not making money, you actually are, so that kind of documentation. And then 2, if you truly aren't making money, but you know by year 5 I will be, if you can outline what that looks like from a financial projections perspective, that probably would be helpful as well. And this is all said with each individual situation is different, and I'm sure the person asking the question knows that. But just to say, meeting with that lender and talking through and asking, is there information I can provide that you don't have that would be helpful, is an easy way to the next step. They should be able to tell you if there would be information to get you a different loan decision, what that would be. But I would say one or two of those things: information that says I am making money, or information that shows when you will make money. I hope that answered your question.
All right, so that's the only question we have right now. So if you want to go on to the financial information, that'd be fine.
Sounds great. Thanks, Jenna. All right, so I kind of went through the business plan. That's kind of topical or more qualitative information. Now I'm going to go through the quantitative information. Anybody that's been through the loan process knows that any lender, Farm Credit or otherwise, is going to ask you for financial information. So they're going to ask you for those tax returns. They're going to ask you for balance sheets. And so I'm going to do my best to walk through what that information is and what Farm Credit, in our perspective, is taking from that information to make a loan decision. And so hopefully at the end of this section, you'll understand why we're asking for the information. At our Growing Forward conferences, I tell customers, we're not trying to be nosy. We want to be able to give you the best yes decision or the best no decision for your operation. And so you giving us your best financial information is going to get us both where we want to be. So my first question, if you are a farmer, you have a operation, do you provide updated financial information yearly to your lender? My guess is a lot of people are going to say no. And this is the single best thing you can do for your operation. Excuse me. The single most important thing we tell our Growing Forward customers, we spend a day and a half with them, give them lots of information, and if they gain anything from our time together, it's provide updated yearly financial information to your lender. It's the best thing you can do for that relationship. So I'm going to go through what is that yearly financial information, right? So the first is a balance sheet. I'm sure most on the call have had to fill one out. Shows the overall financial position of an operation or a person, or a combination of an operation and a person at a particular point in time. So it's important to know that it's a static document. So that person asked the question earlier, balance sheets don't change. So if we have an outdated balance sheet, we're working from old information. So that's why we continually ask for those year over year, because we want to be able to see the progress or possibly regression that an operation is making. And so it has two things. It has assets, what you own, and liabilities, what you owe. So sitting down and thinking of every possible thing you own and every possible debt you have out there is a good starting point to creating a balance sheet. A little bit of a pro tip, kind of funny but also serious. So it's New Year's Eve, we interrupt your celebration to look at year-end financials. So the best time to do it is 12/31, December 31st, or in line with whatever your tax year is. Most people, tax year is your calendar year as well. But it helps us keep things consistent. The biggest thing it does is it lines up that static information, so your balance sheet, with the same cycle your taxes are. So we're able to line everything up in one year to put things all in the same year to say whether you're making money or whether you're not. And for lenders, it gets us that complete picture. We're able to do what we call accruals. So basically what we're doing is we're getting all the income. Maybe it came in later in one year, but it was actually earned in a certain calendar year, and all the expenses. Maybe we had some prepaids, but those aren't really going to be used until the year after. Accruals let us separate and put into certain years everything that makes sense to go in one year. And so for that person asking that question earlier, a lot of times this can be solved by simply having really good 12/31 balance sheets that match up with those tax returns that you have, because it actually shows that maybe you were making money when your taxes said you weren't. And so that's kind of a unique thing to agriculture that we don't always think of. We understand why you're buying prepaids and why you're purchasing those things at the end of the year for tax reasons, but oftentimes that makes our financial picture look pretty yucky. So if we can combat that by having end-of-year balance sheets so that we can put all the income and expenses together in one year to say, oh, you know what, they actually are profitable. They are making money on that operation. But without those two pieces of information, we can't do that. So I'm going to break down the balance sheet. I'm not going to spend a lot of time. It's pretty basic stuff, but if somebody wants me to dive deeper into an aspect of the balance sheet, just send a question and Jenna can ask that at the end of this session. But an asset is property owned by a person, can be converted to cash. I will say about assets, something that often gets forgotten is even if you have a liability out on that asset, you're still including the full value of that asset. So if you've got a home or a piece of ground or something where you've still got a loan on that piece, you're still going to include the full value of that asset. We're going to capture the liability on the other side of the balance sheet. So liability, a debt owed by a person or a company. Really 4 quadrants to the balance sheet. So that top half is going to be anything current, less than 12 months, and the bottom half is anything past 12 months. So current assets are something that we can easily convert to cash within 12 months. So cash, feed, growing crops, grain, again, less than 12 months. Current liabilities, anything that you're going to owe within the next 12 months. And jumping down to the bottom half, non-current assets, anything that you're going to retain past 12 months. I like to tell people too, this is anything that you're not normally going to sell, right, in the normal course of business. We're not going to be selling equipment within 12 months because that's counterintuitive to operating the business, right? We need the equipment to continue operating. Breeding livestock, we're not going to sell our breeding livestock because we keep those year over year. Vehicles, real estate, anything like that. Non-current liabilities, that bottom right, anything that's not going to be due within 12 months. So if it's not due in that top half, it goes down in the bottom half. Often that's mortgage loans, equipment loans, livestock loans, anything kind of outside of an operating line or credit card statements, things like that. This is just to give you a high-level example of what a balance sheet could look like. I'm not going to spend time on this. This is, again, merely just an example of how we break down a balance sheet. I did think I'd share, you're talking about a lender's perspective, things that we commonly see as missed items. Any kind of accounts payable or receivable you have, so if you owe somebody some money or somebody owes you some money, that's often forgotten on a balance sheet. Grain inventory, so if you've stored some grain and haven't sold that yet, that's often forgotten as well. Details on your debt, so rate, term, different things like that. That's not always a lender being nosy. That's a lender trying to get the most accurate picture of what your debts actually look like. Medical bills are often forgotten. Fuel, inventory you might have for other businesses. So a lot of times in agriculture, we have a lot of side gigs, right? We use an equipment for different things. We might have lots of different jobs going on, so we may have some inventory from other businesses we've got. we forget that often. And lots of times just spouses information. So agriculture can get messy in the sense too that on a balance sheet we often have our own personal information and we have business information, and so remembering that we have our spouse's information as well on there sometimes, or what we forget on a balance sheet. We talk about what a lender gets from a balance sheet, so why it's important that you provide this information to us and that it's accurate. Here's what we're actually calculating when we get your balance sheet: your total equity, your net worth. We're calculating your working capital, and we're calculating your solvency, your equity to asset ratio. The stronger these ratios, the more options you have available to you as the producer. So we're trying to gauge where you're at in those three buckets, and I'm going to walk through a little more in depth as to what each of those buckets is. So total equity, we're just going to take your total assets, so that left side of the balance sheet, minus your total liabilities, the right side, and we're going to get what you're worth. So it's really the portion of assets that would still remain if everything on the right half of the balance sheet was paid off. So you paid every debt you have, that total equity is what you have left. So we use the whole balance sheet. When we talk about a risk rating, it's either positive or negative. Obviously, the higher the net worth, the better. But equity and net worth take time to build, and it'll kind of wave over time depending on what your risk appetite is on your operation. But we like to tell people, think about net worth, and I'll get to a solvency ratio, I think, here in a little bit, but the more of you, the more of your assets you own, the more power you have to make decisions on your farm is kind of the key takeaway when we're talking about your equity position. Working capital just deals with the top half of the balance sheet, so we're going to take those current assets minus your current liabilities, and what's left is your capital that you have on the operation to work with, right? So it's really your short-term risk-bearing ability. If we come across kind of like, honestly, the situation we're in right now with COVID, hopefully it's short-term, none of us really know, but your ability to withstand some adversity in short times is really your working capital. So oftentimes, you know, people say, oh, pay off debt, pay off debt, pay off debt. And while that's not a bad thing to do, sometimes it might be important to save some of that cash and keep it on hand to weather storms and withstand some of that short-term risk. And that's really a conversation to have with your lender. And so if I know what your goals are, I could probably tell you if it's a better idea to keep that cash on hand or whether paying debt down makes sense. For every operation, it's going to be different. But what are we going to use things like, what kind of working capital, or when does working capital come in handy? Things like when harvest might be bad, prices, again, situations like we're in right now, just short-term risk, it's helpful to have working capital on hand. And then that last piece of information we talked about is the equity to asset ratio, so solvency, so what I alluded to a little bit earlier. It measures how much of your operation you own. So you can see that risk rating right there. Anything greater than 65 is considered good, green to go. 55 to 65 is kind of that neutral territory. And anything under 55% is risk rated red. 55% solvency for our young customers isn't a bad thing either. What I like to tell people is if you own more than 50%, then you have majority interest in your operation, right? If you own less than 50% of your operation, then that means somebody else has majority control. And while that's not necessarily a bad thing for younger farmers, that is a number we want to see continually grow, because as you get closer to the end of your operation, or you talk about succession planning and passing on that operation, owning more of your operation is a really critical piece to being the decision maker and having the power to make those kinds of decisions that you want to make. So solvency takes a while to build up, and it's something, from a lender's perspective, we like to see that grow over time. So if we have correct information year over year, we can identify trends. Trends are really powerful at Farm Credit. There's something, or really any lender, we're wanting to see trends going up, understanding that in bad times, trends can go down, and that's okay. We know we work in agriculture in a very cyclical market, but we want to see overall over that operation's whole length, we want to see those trends going up. We want to see your equity position increase. We want to see you holding on to and growing your working capital position. And then we want to see that solvency and your kind of your own stake in your own business continuing to grow as well. So basically, if we want a quality decision, we have to start with quality information. All right, so that's kind of the balance sheet side from the financial statement section. Jenna, were there any questions before I dive into the income statement side?
I do not see any as of right now.
Okay, great. All right, so balance sheet, we talked about why that's important, why we want 1231s. Now I'm going to talk about income statements, otherwise known as taxes, how we use those taxes to put together an income statement. But your income statement's really capturing three things for us: revenue, expenses, and depreciation. And ultimately what it's telling us is your operation profitable? Are you making money? Because like I said, we want to make sure we're paying loans back with profits and not just sale of assets. So some key terms, put these up here, but revenue is really your total income derived from selling your goods, services, expenses, those costs that you have by selling those goods and services. Depreciation, decline in the physical assets, not an actual cash expense. And really value of farm production is a term I'm going to be using quite frequently. For most grain operations, it's the same as your gross farm income. But what value of farm production is trying to say is it's really the value of what your farm is producing. So for cattle producers, that might be a little bit different. If we're purchasing feed, inputs, or purchasing livestock for resale, your farm didn't actually produce that feed. That could be different, but if you're buying that feed, your farm didn't produce the value of that feed. It didn't produce the value of the livestock you're selling for resale. And so really what we're trying to measure with value of farm production is what your gross farm income is, what the value of what your farm is producing is. So I just put that in there because sometimes when you work for a company or you work in your own little space, you use acronyms. I don't want to start rambling off VFP and people not knowing what I'm talking about on here. So I've alluded to this earlier, but I think it's important to talk about why is profitability so important. So at Farm Credit, we are an earnings-based lender. And so what that means is we want you to pay back your loan through profits from your operation. And so if you start there on the left, you get the loan, you're going to pay it back with earnings, so profits from the operation. If we can't pay it back with earnings, we're going to dip into savings, right? So hopefully in that working capital, we have some savings built in for tougher times, right? When we're not getting the prices we want to see when we take things to market and we have to dip into savings. Totally okay. When we run out of savings, then oftentimes we're going to refinance. And if we refinance and it's still not working, that's when we're going to have to sell assets. And so we don't want that to happen. And so profitability is a really important thing for a lender to be able to see, and for you as a business owner to be able to communicate and understand what competitive advantages you're going to have to be profitable on your operation. So just like we walked through a balance sheet, what does that tell us about an operation? What does your income statement tell us about your profitability on your operation? So here's kind of what we can glean from an income statement from tax returns. We can calculate your liquidity position, and we'll walk through how that's calculated. And we're also going to calculate your debt coverage ratio. And same statement on this slide as previous. So the stronger these ratios, the more options you have available to you as a producer. So to get that liquidity position, we're going to take your working capital, and we talked about that earlier. We're going to divide it by the value of the farm production, or your gross farm income for most producers, and get your liquidity. So it's really your operation's ability to meet your short-term debt without disrupting your day-to-day business. You can kind of see the risk rating there. So anything greater than 30% is good, 20 to 30 neutral, less than 20% is not a great liquidity standard. That's not to say in tougher times we don't see liquidity dip down into 20%, but ideally we'd like to see that above 30%. So how much working capital do I need? Really, that's different for each operation, but really the number tells you how much cushion you have relative to the size of your operation. So if you have $100,000 in working capital, and again, working capital is that current assets minus current liabilities, that's very different if you have 20 acres versus 2,000 acres. So just thinking, you know, the greater my farm size, the greater amount of working capital that I need. The next one I was going to talk about is debt coverage ratio. It's kind of a hairy calculation. I'm not going to walk you guys through debt coverage ratio, but debt coverage ratio is important to understand because it looks at all of your income. It factors in your cost of living, adds back in things like depreciation, and it's really giving us an idea of how much margin you have left over. What's your ability to cover all of your debt and then have leftover money. So on this next slide, for every dollar of debt that I have, how much extra do I have to service that debt? So anything greater than 1.5 means I'm covering all of my debt. That's where we get the 1. And then I have a 50% margin. I've got 50% left over and that you're going to feel that. 1.2 to 1.5, so that's giving you 20 to 50% margin left over once you've paid all your debt. And then anything less than 1.2, you're probably going to feel it. I always tell our young producers too, you know if your debt coverage ratio is low, you may not know, going back to this slide, you may not know exactly how to calculate that, and that's not your job, that's your lenders. But you're going to know if your debt coverage ratio is at 1% or lower, because it means you're barely squeaking by. And in life, when we're barely squeaking by, we can feel that. And so just having that conversation with your lender, if your debt coverage ratio is getting lower on things you can do on your operation to try to increase margins, is a good conversation to have, and also recognizing that your lender understands the economic cycle we're in right now. And so we're not seeing risk levels at 1.5 right now. And that's not the case for every operation. There are some very successful, viable operations right now. But we understand in cycles like this, that debt coverage is going to be lower. And that's okay, but what is our plan? What conversations are we having with our lender? Conversations are we having with our farm partners to get that debt coverage ratio up, to get our profitability up? What kind of expenses can we cut if there's anything left to cut? Just thinking through some of those things that are going to help increase that debt coverage ratio. So, you know, we tell our, and this is really relevant for our young producers, but honestly anybody, is if you have ways of getting off-farm income, now's not the time to quit doing that. So some of the easiest ways is just looking off the farm. So finding that off-farm income, getting stability from a healthcare perspective. But honestly, before you make a decision that's going to impact your earnings, talk to your lender. So let's say last year when you provided your balance sheet and your income statement to your lender, somebody on that balance sheet had an off-farm job, right? And so our income was showing $20,000, $30,000, $40,000, $50,000 more a year, depending on what kind of off-farm job they have. And you make the decision, we're going to quit that job, we're going to go full-time farming. That may be the right decision, but talking to your lender is really important because we made a loan decision based on having that extra $20,000, $30,000, $40,000, $50,000 a year, and that could impact your financial position. And so we don't want you to come back a year from now for a new request and be surprised when we tell you no because the income just isn't showing a yes decision. And so anytime you're going to make a decision that impacts your earnings, talking to your lender is a piece of really important advice I would give to each of you guys. Is if they're a partner at the table when making financial decisions, they should be a partner at the table when you're talking about getting rid of certain aspects of your personal operation, business operation, things like that. So just remembering that they are part of that conversation is a really helpful piece of information. For those of you that have had the opportunity to watch Dr. Cole speak, he often says, I've never seen a farmer go broke paying taxes. And we like to say there are worse things than paying taxes. So we understand that you'd rather buy something new than have to pay Uncle Sam or pay taxes. but oftentimes that can be a trap. So if you're purchasing a $250,000 piece of equipment just to save $5,000 in taxes, are you actually coming out ahead? So all this to say, we know that tax mitigation is an important strategy for your business, for your farm, and that you have a partner at the table, your accountant, your CPA, that's going to discuss that with you. But just consider discussing it with your lender as well, back to the goals of the operation. If you purchase a $250,000 piece of equipment, that might mean we have to say no to those 80 acres that we talked about earlier. So each purchase you make impacts purchases down the line. So not to say that you can't buy pieces of equipment, that's important to an operation's success as well, but just thinking long-term what makes the most sense for me and my operation is something we urge you to consider. Talking about collateral, just to mention it, it is something that a lender is going to talk to you about. It's our way of securing our risk and just securing that note or mortgage that we're giving you, and it should be of greater value than your loan amount. So how does the lender determine the value of collateral? We use appraisers that go out, do market value. We see what else other things are selling for, what the market's currently saying that's worth, and that's how we're going to value that. And you might say, why are lenders asking for more collateral today? We may not be asking for more. We just want to make sure that we're doing our best for you and us. And as a cooperative, we have a lot of customers, and so if we are not properly securing ourselves on our end, then we're not doing our best for our cooperative as a whole. And so that's why you're going to see lenders just making sure they're well secured. But I would go back to that one slide earlier that says we want you to pay us back with money earned and profits from the operation and not the sale of assets. So our goal is never to have to sell assets to pay back a loan. We just want to make sure we're well secured so that we can continue to serve you and our customer base as a whole going into the future. Any questions, Jenna, before I kind of switch gears into some other things the lender might be prepared to talk to you about?
No, we do not have any at this time.
Okay. So I'm not going to spend a lot of time. I think I actually just have one slide on credit score, just because it is something that oftentimes when we think about lenders comes up. So your credit score is really your financial GPA. It's really like a resume if you're applying for a job. It's not the whole picture, just gives us a quick picture of your financial management. So it really just tells us how likely are you to default in the next 24 months. Most people know this, but just a breakdown of what those scores look like. That good, very good range is what we're kind of looking for at Farm Credit. But just something to be prepared for, and I encourage everybody to know what your credit score is, to not be scared to look, because that is something that could come up in a conversation with a lender. So just being prepared for that is probably a good piece of advice. I probably asked one slide too early, Jenna, but I'm going to jump into lender expectations unless she tells me otherwise. So what are some of the characteristics of top producers? So I went out and asked some of our loan officers, what are the best qualities of your best customers? And so here's what they said. Those that look for continuous improvement are always seeking feedback. So sometimes we have to tell customers no. It's just not the right time. They're not ready for that purchase. Lots of different reasons why an answer could be no. But those customers that are always listening for the why behind the no are seeking feedback maybe outside of loan decisions. So they're meeting with their loan officer, not just because they have a loan request, but just because they want their input and want their feedback, are some of the very best customers we have. For those of you that have been in academia before, you think of students that are constantly seeking feedback, asking for ways they can improve. It's no different than an operation. So just thinking about how can I use my resources, how can I use my lender to help make my operation better is one way to be one of the best customers that a lender is going to have. The second piece, accurate, consistent information that's readily accessible. So, at the end of the call, how many could say, I have my business plan, all I have to do is hit print, and I could give it to my lender, my accountant, whatever business partners I have, or at the end of this call, I could go print off my 12/31/2019 balance sheet. If you can answer yes to that question, or you can say, I'll do you one better, my lender already has that information, those are some of the best customers we have. When you come in for a loan request, maybe there's an auction that's coming up and you're interested in getting pre-approved. A lot of times if we already have that information, we can give you a yes or no decision. If we don't have that information, to get an answer back to you in a day, 2 days, depending on how quickly you come in, is really difficult. And so if you're looking for ways to be a really good partner in the lending process, having that accurate, consistent information that you could hand off as soon as it's asked for is one of the best ways to do that. And then finally, the ability to have a constructive conversation. And it kind of goes back into that first one. But how open are you to having conversations that might be a little bit difficult, that might challenge you, that might challenge your operation and what you've thought are good ways to become better customers and really to become better producers, or to have those constructive conversations. So I'm going to walk through, these are kind of my last two slides. I'm going to take a little bit of time here, but what your lender expects from you. So when you go in to their office or they come out to your farm, what is your lender expecting from you, the customer? So I've hammered on this and I warned you at the beginning, but updated financial information every year. It's the best thing you can do for your relationship with your loan officer. They expect you to pay your loans on time, and they expect you to communicate ahead of time if that's going to be an issue. So really, most recently is the best example with COVID. If you're going through a difficult time, the best thing you can do is tell your loan officer that that's the case and be honest with them, because oftentimes there are solutions we can provide before things get too far down the line whenever we don't have as many solutions available to us. So going into this, we expect you to pay your loans on time. That's pretty standard for any kind of loan you get, whether it's from Farm Credit or your operation or personal loans. But just communicating ahead of time if that's going to be an issue. If you foresee things coming up that's not going to work out, the best thing you can do is tell your lender that, and they would expect that from you. Be as invested in your business as you're asking us to be. So again, kind of back to the silly $20 example of when you're in high school and ask your parents for money, but be as invested in your business as you're asking us to be. If you're coming and asking us for $500,000 for your operation, that's a pretty big investment. And we want to see that you're just as invested. And so things like filling out a business plan, things like providing that financial information are ways that we can see that you're just as invested as you're asking us to be. Big thing, it might seem small, but just using your loan proceeds for their intended purpose. The best example of that is a revolving line of credit, similar to a credit card. If we're not using that line of credit for what its intended purpose was, if we're going out and purchasing equipment on a line of credit, if we're purchasing, things for the family, if we're not using that line of credit for expenses of the business that then we're paying back with profits from the business or revenues from the business, that can be an issue, and that's honestly one of the first places our ag customers start to feel a struggle, is when we can see that the line of credit isn't being intended for its actual purpose. And so your lender expects you to use a line of credit the way a line of credit is intended to be used. Know your break-even. So this can seem maybe a little overwhelming, but your lender expects you to know what your break-even is, and then that just kind of helps take the emotion out of making decisions. If you know what your break-even is, then you know when it's advantageous for you to sell. And so in any other business, we would know our break-even, right? And so agriculture is no different. We don't have excuses anymore to not have that number in our heads And if you don't know how to get there, your lender is going to be able to help you get those tools, help you get an Excel document put together, help you find the right partners outside of your lender that can help you figure out what your break even is. But I think there's no time for excuses anymore to not know what that break even number is. We want you to know that a yes or no decision has you and your operations' best interests at heart. It is not fun to give no decisions. It's not something we want to do at Farm Credit. We want to be able to help you reach every goal you've got, and so we want to be able to say yes to everything you want to do. But oftentimes if we're telling you no, it's because we think that's the best decision for you and your operation at that time. And it's okay to challenge your lender on that if you feel differently, but just understanding that a lender is coming to the table with your best interests at heart, your operation's best interests at heart, and be open to having a conversation about that is really what a lender would expect from you. We'd also expect, so if things need changed, you come to the table with a game plan. So kind of back to that idea that if you're not going to be able to pay your loans on time, if you come to the table and say, listen, things are tough right now and here's why, but here's my game plan, here's my business plan to get back on track, here are a couple of things I've thought about, you know, I could sell this and I can do this, and here's what I'm thinking through, what's your take on it, that goes a really long way for a lender. If you're just coming in saying, hey, can you do this for me, and haven't thought through a plan or a process to get back on track, that's really difficult because at the end of the day, you're the stakeholder in your operation, right? It's yours to maintain, and so thinking through a game plan is really beneficial. Know your short-term and long-term goals for your operation. I'm not going to go into that. We had a whole slide on that, but just knowing where you want to be in 5 years and knowing where you want to be in 20 years, a lender expects you to have a pretty good idea of where you want to be. And then a lender expects you to mitigate risk, right? So we can't avoid everything. We can't avoid things like COVID. We can't avoid things like low prices, but we can do our best to mitigate risk. We can have risk mitigation strategies on our operation. And so we just, from a lender, expect you to think through what does risk look like for you and your operation, and how can I mitigate that risk? Jenna, are there any questions on that slide, a lender's expectations of you, before I get into what you should expect from your lender?
Nope, it doesn't appear like any have come in.
Awesome. All right, so not awesome. If you have questions, please send those in, but we'll go ahead onto this next slide. So what should you expect from your lender? So let's flip the table. This isn't a one-way street, right? Your lender works for you. They're providing you a service. So what should you expect from them? Flexibility, right? So I need you to meet me at my operation. I need you to meet me virtually. I need whatever you might need. You should expect your lender to be flexible, right? You're the customer here. What works best for you? What kind of flexibility can your lender provide you is something you should expect from them. You should expect a financial analysis based on the information you provide. So if I, as your lender, am asking you for a balance sheet, 3 years tax returns, a business plan, whatever it might be, you should expect commentary on that information you're providing, right? So I'm going to give you a yes or no answer, but you as the customer and the business owner should expect some analysis on that information that you've provided, right? So if you give me a yes decision, that's awesome, but I'd also like to know, you know, what are my weaknesses on my balance sheet? What are some things I can be working for or working towards? So not only just a yes or no decision, but really some financial analysis, some ways to shape my goals going forward is something you should expect from your lender. Explanation on yes or no decisions. So not only a financial analysis, but why are you saying yes and why are you saying no? Is it because I've told you my long-term goal and you think that we're not going to be able to do the purchase 5 years from now? I might still be saying yes, but there should still be some explanation that says, yes, you can do this now, but that might mean that the next decision is no. And so you should expect commentary around yes or no loan decisions. Kind of feeding into that, dialogue on what short-term debt can do to your long-term goals. So that that scenario I just used there, if you're saying yes to the piece of equipment now, you should expect some dialogue on what that could mean if you come in 3 to 5 years from now asking for a longer term debt structure. So if you're asking for a real estate purchase, what that short-term debt could do to that long-term purchase. You should expect financial tools and resources. So earlier I talked about knowing your break even. A lot of your lenders are going to have Excel tools, or they're going to have stuff that they use that they can offer to you, or places you could go to get that information. So if you're struggling with where to go to get those tools and resources, ask your lender. They should be able to get you to the right place to get that information. Those ratios that I walked through, I'm in no way expecting you guys to know how to calculate those. Not to say you couldn't learn and figure those out. They're not complicated, but your lender should understand how to calculate and communicate the ratios on your operation. So you provide all that financial information. They should be able to tell you what your ratios are if you want to know those, and communicate what that means for your operation. Communicate what your liquidity position is. Communicate what your solvency position is and how you can improve those numbers if that's something that you need to do. A communication style that matches yours. So maybe you love to talk on the phone, or maybe you prefer a text, or you're an email kind of person. You should have a communication style that matches yours. And so I wouldn't be afraid to tell your lender, please email me. I do not like to talk on the phone, or only call me. I don't read my email. I don't do texting. Whatever it is for you, whatever your communication style is, you should expect your lender to adapt to that. You should expect your lender to know your short-term and long-term goals. So if you've done the hard work of telling your lender what those short-term and long-term goals are and they can't remember them, I would encourage you to have a conversation about that or find a new lender. I want somebody that knows me and knows my operation, and I think you probably all want that as well. And then somebody that can just explain the options that are available to you when times get difficult. So that's never an easy thing to talk through or talk about or have to go through, but you should have a lender that can explain what options are available to you if you get to that point when difficult decisions have to be made. So that's kind of high-level overview of what you should expect from your lender. And I just tell you that while your lender expects a lot from you, investing into your business, you should expect a lot from your lender. You know, you're investing in them and their services. So it's a two-way street. And with that, that's kind of all the prepared material I have. But I would just encourage you to take the anxiety out of sitting down with a lender. If you've had not great experiences before, try again. Try a new lender, try the same one, give them another chance. Nobody's perfect, but at the end of the day, your lender wants the best for you and your operation. And so you doing the best you can to come to those conversations and those meetings prepared will make that relationship mutually beneficial. So Jenna, if there are questions, I am happy to answer those. If there's questions you get after today via email, I'm happy to follow up with those as well. So I'll kind of turn it back over to you to wrap up.
All right, so we do have a question. For young farmer loan, is that new farmer in terms of age or new to the farming operation?
Yeah, that's a great question. So both. So for growing forward, we use two categories, right? So the first is anyone younger than 35 years old, excuse me. And the second is a beginning farmer. So anyone with less than 10 years of farming experience. The way we measure that is Schedule F income. So if you have, 10 years of tax returns with Schedule F income that says you've been doing this for 10 plus years, we're not going to consider you a beginning farmer. But for the most part, those are the two categories, less than 35 years old or less than 10 years of farming experience for our Young Farmer program.
All right. So far, no other questions have come in.
Okay.
I do want to thank you, Dakota, for joining us today and making accommodations so we could finish the grant up. We want to thank all our participants for hanging in there with us as we went through this program series. And when you receive the recording for those of you that weren't able to join us today. We will also be sending out a link so that you can complete a survey so we know kind of how we did on the program and what other information you would like to learn. But above all else, we are really appreciative of everyone for participating and Dakota for joining us. So thank you guys and have a good day.
Yep. Thanks for having me, Jenna. See you guys.
Bye.